Welcome back, guys. Let's move to our step number 2 of IFRS 15, that is understanding the performance obligations in a contract. Now, what is meant by performance obligation? It means the promises identified in a contract which are deliverables to a customer. For example, if in a contract if we have promised that we will give XYZ three services, now this three services becomes the deliverables to a customer, and in turn it becomes the performance obligations for us, for which we are going to receive the consideration. So what is the definition of IFRS 15? It says that revenue should be recognized for each performance obligation at the fair value of the consideration to be received or received. That means, first of all, while reading a contract, we need to identify what are our performance obligations in a contract. Now, it can be a different goods or a service, or it can be a series of a different goods or a services. For example, if there is an IT company which has support and maintenance ticket person sitting, now he is just providing a ticket services on monthly basis. If ticket comes in, he will resolve. If ticket doesn't come in, still company will be required to pay him. In this situation, we are providing a series of services that will going for a certain number of months or a certain number of periods, and the revenue recognition model remains the same. Now here the one of the catch is, it may happen that in sometimes in a contract deliverables may not only be the deliverables or the performance obligations. There can be a customary business practices as well. For example, let's say I'm a tax consultant and I'm filing the tax returns for my client. A client comes to me and say that you need to file my tax, but he don't have books of accounts ready, he don't have any information finalized yet. So for me, the first deliverable is preparing his financial statements. Second is to assess and analyze the requirement of the taxation authority and prepare the tax books, P&Ls and balance sheet. So here, even though contract just says a tax return is my performance obligation, because of my customary business practices or a routine business practices, I have to first prepare his books of accounts, financial statements as per statutory records, books of accounts, financial statements as per the tax filings, and then only I am able to do his tax filings. So this will automatically become my performance obligations. However, there is another catch, that activities which are required to be performed to make a deliverable successful is not a part of performance obligation. For example, customer has come to me and say he wants books of accounts to be finalized. Now to do this, I need to review his journal entries, his cash book, his bank book, the ratio analysis, previous year books of accounts. Uh, I have to review a lot of activities before finalizing the balance sheet and profit and loss for my customers. So activities which are ancillary part of providing my services do not become the performance obligation. However, the activities which are deliverables which customer can be benefited, those will qualify the performance obligations. So let's understand two examples. In first case, I say I have to prepare books of accounts, balance sheet, P&L for statutory records, books of accounts, profit and loss balance sheet for tax records. Now, even though contract does not specify this as a deliverables, the customer will be benefited because of the statutory accounting, tax accounting, and the final tax return filings. But the activities which I will undertake to prepare my books of accounts or a tax books of accounts, those will not be my separate performance obligations. Why this is important? Because the revenue will get recognized at performance obligation level and not at contract level. So it may happen that for one performance obligation I am recording a straight line revenue, one performance obligation I am taking cost completion method, one performance obligation I am recording as a product sale. This we will understand in step 4, step 5, and how to allocate the value. This will also will understand in step 4 and step 5. So this is the very small brief concept of identifying a performance obligation. Just to quickly revise, it is goods or a service promised in a contract to be transferred, which is a deliverable to a customer. It does not include routine ancillary activity to perform your business, but there can be a customary or a business practices common to all the customers. We may have implied performance obligations in a contract. That is it for the second step. For the next step, we will meet for the step number 3, that is determining the transaction price. Step 4, allocation of the transaction price for the performance obligations which we have just identified, and then step 5, revenue recognition model. So cheers guys, goodbye till then, have a nice day.